Let's get started. Thank you for joining us today for the University of Texas Energy Symposium, University of Texas at Austin's Energy Symposium, sponsored by the Energy Institute. I'm Carrie King, Assistant Director of the Energy Institute. Before I introduce today's speaker, I will note two of the upcoming talks. Next week, we will have a kind of special edition on a similar topic, fossil fuel divestment. So this will not be a traditional talk. This will be an Oxford-style debate where you, the audience member, gets to vote who wins the debate on this question of whether universities should divest their investments from the fossil fuel industry. After that, 2 weeks, we will have a talk from Jan Mertens, Chief Science Officer at ENGIE in France. So 3 talks in a row here on issues related to energy transition and fossil fuels and carbon dioxide. So today it's my pleasure to have Gregor Semenyuk. He is Assistant Research Professor at Political Economy Research Institute and the Department of Economics at the University of Massachusetts at Amherst. A little background on Gregor. His research focuses on the energy and resource requirements of global economic growth and on the political economy of rapid policy-induced structural change associated with a low-carbon energy transition. He's published in prestigious journals such as Nature Climate Change, Nature Energy, and he's consulted for the UN, European Commission, and the United Kingdom government. He has a PhD in economics from the New School for Social Research. And today he's going to talk to us about stranded fossil fuel assets during a transition. And here is the abstract of his talk. I will leave for posterity here, but perhaps instead of saying what he's going to say and tell us today, I'm just going to let him start talking. So as always, if you have questions, please ask them in the question and answer feature. Gregor, please go ahead and share your screen and ask them in the question and answer feature of Zoom, or if you're watching on YouTube, you can type questions on there and I will be looking there as well. So I will now stop talking and let Gregor continue, and unmute yourself, Gregor, when you get started.
Okay, can you hear me?
Yes, and the screen looks good. Thanks.
Thank you. Well, thanks very much, Kelly, for inviting me to this symposium. It's a real pleasure to present here. Thanks also for the introduction. You have seen the title, Stranded Fossil Fuel Assets Translate to Major Losses for Investors in Advanced Economies. This is a paper co-authored with my wonderful colleagues who are here on this title slide. And the paper has recently been published in Nature Climate Change. So I'll basically walk you through that paper. And I might mention towards the end a few extensions that we are working on right now. All right. So that's the structure of the presentation. I'll motivate it a little bit, then tell you how we set up our modeling, and then 2 sections of results, where the losses from stranded assets go, where they propagate, talk about amplification, and then interpret these results from a political economy point of view. And down here, you see extra slides. You can follow the structure up here, and I might jump back there, or in the Q&A, there's some more information. Now, at the root of this talk is basically this extreme uncertainty about where future oil and fossil fuel demand in general goes. On the left-hand side, you see a figure from the Saudi Aramco 2021 results report. And it's titled Significant Underinvestment in Supply. And what you see here is that according to that company's estimates, global investments at the time of the publication led to a declining ability to produce oil over the period 2020 to 2030. And according to their demand forecast, much more new investment would be required to meet demand. All right. So there's a shortfall of investment in order to meet demand. But as all of you have probably seen, the International Energy Agency forecasts that, unless really nothing is being done about climate change, oil demand might actually peak below 100 100 million barrels of oil a day, and you can see here that Saudi Aramco thinks this is going up to 106, right? And it's just an example. There are other oil companies out there with their own forecasts, and if pretty advanced policy were to take place, this decline might actually be very rapidly and go down below 80 million barrels a day global oil demand. And obviously any supply over and above that couldn't be brought to market, and production would probably decline, perhaps after investments have changed, because, after investments have taken place. Because the issue is, of course, you have to invest today to produce tomorrow or in a few years' time. And so if investors make investments given fairly sanguine expectations about demand, but that demand does not materialize, there's a risk of stranded assets, in particular when these expectations are already reflected on the balance sheets of oil companies and gas companies. So this is the background for our talk. We're trying to put some numbers behind scenarios where expectations might change basically today about oil and gas demand in the next 15 years, which we think is a plausible horizon over which some of these companies are planning their investments. And what would that do to valuations of such companies? And then what that actually means for the financial owners. It's not just these companies that are having an interest in making money, right? It is also the investors behind those companies that are ultimately, underwriting the valuation of these oil companies by holding their assets and thereby also believing in these expectations. So our research question is, who ultimately owns the mispriced upstream oil and gas assets at risk of stranding? Mispriced, conditional on a low oil demand scenario actually ultimately being expected after a higher scenario is initially expected. So what do we do? Well, first of all, we set up a map of the global financial geography of the risk of stranded assets. So we basically trace the ownership of oil company stock, and in fact, even the risk, the ownership of profits, future expected profits from all the oil and gas wells around the world to final ultimate owners, people like you, if you own maybe shares in a pension plan, or governments, if it's a national oil company, or perhaps, fairly affluent people who have their own drilling company. But it's all people and government, these ultimate owners. It's not companies that just hold shares on behalf of ultimate owners. So to repeat what I just said, I guess, we do this in a couple of steps. We start at extraction sites, go to corporate headquarters, and then we trace the ownership of shares and therefore transition risk through immediate and proximate shareholders involving the financial industry, and then ultimate owners. In terms of what literatures in academia we speak to, we're basically providing a bridge between the stranded assets literature and the transition risks literature that are often, are a little bit separate, because one literature estimates the amount of stranded assets and the other asks whether this should be an issue for financial systems. But they typically start from synthetic shocks. And so we're starting with stranded assets, but move to the financial system. So what do we find? Here's just a quick overview. So with plausible expectations about future profitability of oil and gas assets, we find that it's likely that there's more than $1 trillion in lost asset value today, and that about 15 to 20% of that loss is transferred through the ownership chain that we map through this financial geography to investors in OECD countries from oil and gas production assets that are not in OECD countries. So think of an oil company, say in Texas, that has a production service agreement in Nigeria and therefore has a claim on some of the future profits. It's something like that. This transfer is pretty robust across scenarios. Of course, the amount of assets lost varies depending on what assumptions we make about future demand. But this transfer in percent is pretty robust. And we find that there's a strong exposure through fund managers, and therefore including through pension funds, which makes it a socially relevant problem, right? It's perhaps not only very rich investors that are affected and that are, perhaps have a very large portfolio of other investments, but it is also people who might depend on these investments for their pensions. And we also find that governments likely ultimately own less than half of the losses in future expected profits that become stranded assets discounted back to the present. And that's perhaps a little surprising because this is a contrast with studies that estimate the oil reserves that cannot be extracted to stay within certain limits and certain CO2 budgets. We're not asking about all the reserves, we're asking about what investors might reasonably be expecting to make a profit on in the next 15 years, which is a small subset of the oil reserves underneath the ground. So we're looking at much more short-term horizon here than you're probably aware of the McGlade and Ekin study from 2015. Recently updated. So we're looking at a different system boundary here. And in that smaller, more near-term system of 15 years, governments are likely less exposed than those national oil company ownership of resources far into the future, to the end of the 21st century. Okay, so with that motivation and overview, let's jump right in to our method here, and I should conclude this overview by saying, well, as a it's a kind of a flip side of this government owning a little less, OECD investors, mostly private persons, therefore own much more than the geographical distribution of oil and gas production currently suggests, and that is basically this transfer here that we're finding. Okay, so let's move on. How do we do all of this? Well, first of all, we define stranded assets as a change in expectations about the present value of discounted future profit streams. We're using a discount rate of 6%. We do some sensitivity analysis about that. We calculate the profit given one set of expectations for Rystad's set of global oil and gas fields, which is about 43,000. And whether or not a site supplies in the future depends on its economics. If it's a costly site, it stops supplying. If if demand goes down, then the most costly sites shut down. And so there's basically a global oil and gas market, which current events might throw some doubt on. This modeling took place in 2021. We can discuss this at the end. But so the economics determine which sites supply. And basically, when demand is revised downward, when expectations change, some sites stop producing. And that's regulated by a lower price, which, by the way, also means that even if you keep producing and you were expecting a higher price, you have still some stranded assets because you have to sell at a lower price. Now, we're using an integrated assessment model, the E3 and EFTT Gini model, which we describe in much more detail in the companion paper in Nature Energy, which we published with roughly the same author group in 2021. So do check that out too. It's called Reframing Incentives for Climate Policy Action. And there we also describe the scenarios in more detail if you want to follow up. Now, to give you a rough idea of our global model and what the change in expectations does to oil and gas revenues and profits. So on the x-axis here, you have our 15-year horizon from 2022 through 2036. And on the y-axis, you see revenue and profits in the oil and gas, in the upstream oil and gas industry. And so we calculate that with basically it's the IEA 2019 step scenario that we're using, which we call investor expectations, assuming that those are the initial investor expectations under which some investments will have taken place. Revenue basically grows over time, and so do profits down here, this dotted line. Now, if expectations change to a so-called EUEA-SO scenario, which is a scenario that leads to about 2-degree warming. The acronym stands for European Union East Asia sell-off scenario, where the European Union and Eastern Asia, being net importers of oil and gas, decide to make good on their climate targets and go to net zero CO2/GHG in 2060/2050, and thereby really curtail the demand for oil and gas. So it's not a completely, not one of those normative scenarios leading to 1.5 degrees Celsius, but scenarios assuming certain policies are implemented by countries that have an economic incentive to do so. And so this is our central scenario that we'll be talking about. And the sell-off means that low-cost producers, realizing that demand for their product terminally declines, try to capture the declining market and therefore increase their production. So you see this dark green wedge, that's the lost revenue, the integral over time, and the lighter green wedge is the lost profits, which is of course a subset of that, because part of the revenue goes to cover costs and pays employment, wages and so on. So that's another issue that we're not treating here, but of course there are not just lost profits from stranded assets. So we're looking at this small green wedge down here, which nevertheless, even if you discount it at 6% per year, leads to 100 billion or so not being realized about every year after a couple of years into the future. Okay, so we're looking at these light green wedges, and this is the global total, but we're of course asking then, well, which oil sites have to be shut down and which investors get to feel this loss. Okay, so we actually have several scenarios, and we call the change in expectation from one scenario to another an expectations realignment. So that combines two scenarios, and our realignment is exogenous. We just assume it. So we do not model investor behavior as some reaction to some movement in the markets or some policy decision. The idea is basically that, well, there are plausible scenarios of the future where the demand for oil and gas declines, basically because of stronger policy actions. And this medium scenario is what we just looked at, from investor expectations towards this, kind of hard-headed, those who import fossil fuels try to shift away from them scenario, which leads to about 2 degrees Celsius warming in our modeling. And in case you're following the NGFS scenarios, the closest couple of scenarios would be from current policies to below 2 degrees Celsius. I'll say a bit more about other scenarios as we go along. But I want you to focus on that one for now. So our network propagation works in 4 stages. First, we determine the non-producing sites using the E3ME model. Then we the site's economics. Then we identify the direct owners of the expected lost profits. We have about 70,000 ownership links to about 1,800 oil and gas companies, which is more than the sites because there can be production sharing agreements or revenue sharing agreements. Then we propagate in stage 3 the losses to corporate shareholders through a pretty large company network, which we draw from Bureau van Dijk's Orbis database. And we find that about 33,000 nodes are affected, one node being one shareholder, and about 16,000 ultimate shareholders are there, which means that those are companies that do not entirely pass on their losses to another shareholder, be it because they're subsidiaries, be it because they're owned by other corporates like financial companies. And let me see if I have I have some additional information here. So from these ultimate corporate shareholders, we're looking who owns these? What are the persons or the governments that own these ultimate corporate shareholders? And to illustrate that a little bit more, all these 4 steps, we're starting at these rigs. Then we allocate the losses to headquarters that are oil and gas companies. We allocate these perhaps directly to ultimate owners because they're persons that are invested as shareholders in the oil company. But perhaps we also find that there are financial companies that are owning equity in these companies. And those are, again, perhaps owned by each other, but ultimately by persons or governments. And sometimes we don't have information. There's some missing data, as you'll see in our results, and we have to make assumptions about that. But generally, we're quite conservative about allocating the lowest possible share to any owners we can identify. So we have maximized the uncertainty in our results by allocating the maximum share that we can find given our information to unknown owners. Okay, so with that, we're moving to some results. So what do we find? Well, basically, this summarizes our results for the medium realignment, sorry. We're finding about $1.4 trillion in stranded assets. And we can split this by major geographies, OECD, non-OECD countries. And we can look at this at every of our 4 stages. So what you see is that about 40% of stranded assets, physical assets, sit in OECD member country territory, and 60% in the rest of the world. The oil and gas split is, it's a bit skewed towards oil, but fairly even in both areas. And then as we move to the headquarters stage, which oil companies are actually operating these and have a claim on profits that are then lost and therefore become a stranded assets discounted to the present, actually jumps to more than half. So there's basically a transfer from oil sites around the world towards OECD-based oil and gas companies, and notably the large international oil companies. And once we move to the corporate shareholders, to these ultimate corporate owner losses, this share becomes even bigger to around 57%, basically because part of the financial sector that is concentrated in OECD countries owns, again, shares in companies that are headquartered outside of OECD countries. And you can see here that when we look at the functional category classification of these corporate owners, we see that there are quite a few funds, quite a bit of ownership through investment funds. Okay, so think of BlackRock running a fund that is invested in an oil company somewhere. It's not BlackRock that owns this risk; they just manage it for fund holders, including as a further intermediary pension funds, for instance, that are then passed on to persons that expect a pension in the future. Okay, so then at stage 4, part of this geographical loss is clawed back by non-OECD countries, basically because they're using asset managers based in OECD countries to manage their pensions. And you can see that in OECD countries, most of the loss is with individuals, whereas in non-OECD countries, it's the reverse. Okay, so this really summarizes our results. We can look at the country level here, which has a lot of detail, and I won't go much into it, except to note a couple of things. So this is a graph with the top 30 losers according to stage 4 losses, meaning ultimate owners. And so you see by the ragged shape of stage 1 losses that there's quite a bit of redistribution across borders. But you also see that the top 2 losers, United States and Russia, are already up there. Okay, so I mean, stage 1 losses definitely tell you something about the ultimate distribution, but not about the exact size. But then you have some countries like, for instance, France here, that basically has no losses on French territory. But once you move to stage 2, you can see that Total Energy, the French major oil company, of course, operates oil and gas wells abroad. Okay, and then as a counterexample, Kazakhstan has quite a bit of oil and gas extraction in its country, some of which becomes uneconomical, but then most of that loss flows abroad. And so the losses at the Kazakh headquarter is a lot lower. All right, and that's how you can read that graph. And the same here at stages 3 and 4. The change from stage 3 to 4, and by the way, from all these stages are indicated by these little discs and diamonds and triangles from previous stages. And we can go back to this if you want to discuss any individual countries in the discussion. The only thing that I want to point out here is that for the United States, the losses increase a lot up to stage 3. Partly this green bar here is fund managers that are being allocated the losses here at stage 3, but part of those losses, this difference between the triangle stage 3 and the actual size of stage 4 bar, are being redistributed to the rest of the world for clients in the rest of the world. Okay. Now, amplification, very briefly. So far, we've looked at propagation. We're taking 1.4 trillion and we're pushing it through the network to the leaves of this tree of nodes that are connected to more and more remote owners. But of course, from a financial stability perspective, rather than a stranded asset ownership perspective, the question is, well, does this pose any sort of risk for financial system stability? And well, we are only looking at the market risk channel. We're only looking at equity here. So basically, we do not say a lot about amplification because most of the trouble comes if there is debt exposure and then interbank exposure that maybe lead to a freeze in interbank lending and so on. So we're not looking at debt data, which is also much harder to get empirically, who holds whose debt, and that's certainly future research here. But even with the market risk, with equity ownership, there are 2 causes of amplification. One is when a listed company owns a listed company, because both listed companies will see their shares fall on the stock market index. And even though there's only one loss, because both companies rely for the valuation on the profits made by company A, and company B owns company A. Think of Bank of America owning ExxonMobil, part of it, and ExxonMobil revising its future profitability expectation, its assets. Maybe Bank of America might be hit, and you'll see then the double dip from the Dow Jones or S&P 500 or wherever they are now exactly listed. And then the other one is where a financial company owns another company because, financial company is basically there to, the valuation of a financial company is justified by making money on investments in other companies, and in our case, equity investments. So if those investments sour, it also affects the financial company's valuation. And so when we look at that, actually, we find that we have a 19% amplification from stock markets, where stock market listed companies own 19% of the of other stock market companies' losses. So we have some of that, part of which is via listed funds. So BlackRock is listed on the stock market exchange, and the idea here would be that, well, if its funds are underperforming, that might affect BlackRock, even though I should say it is not on BlackRock's balance sheet. So we can debate that, and perhaps it's not such a major issue anyway. Perhaps the more interesting aspect here is financial companies owning other companies. And if we add up cumulatively all the losses along the ownership chain that are incurred in financial companies, then we find that we might see the losses in the financial sector. Let me just go back here. That is this part here, these dark and light green parts of the bar in OECD, non-OECD countries. Those 400 something billion could be amplified to 681 billion. Okay, and that actually includes collateral loss due to technical insolvencies, which I can go into in the discussion. It basically means that companies see a devaluation that's more than their equity. So potentially bondholders and those who have issued loans to the company are on the hook because their collateral has diminished. But that's a potential one because a company with a negative equity can continue operating. Whether it defaults or not depends on its cash flow, which we do not model here. Okay, so when we look at these potential amplifications in financial markets, let's just look at stage 3 here. If all of that is added up, this cumulative loss, which is an upper limit in financial sectors because some of the companies might just be subsidiaries of others. We basically see here that most of the financial market that is affected is based in the United States and mostly through managed funds. So it's really a fund management issue here and therefore of the ultimate owners that are invested via funds. Note the break in the y-axis here. This is up to 280 billion on fund intermediate via funds. The distant second is the United Kingdom, which of course also has a very large and important financial sector that is very active internationally. And then you see a few other, mostly, well, countries with a large financial sector that are coming after that. Okay, well, I should probably move towards the end. And so let me give you a few interpretations here. So first of all, when we look at the revenue loss, not at the profit loss, which I haven't shown you here, but which I can quickly go to for you, actually that is disproportionate in OECD countries. So this is what we have looked at so far. It's the profit loss. Of course, the revenue loss is a lot bigger and it's skewed towards the OECD countries, almost half versus 39%, which is because basically it's more costly to extract oil and gas on average in OECD countries. So less profit is left over, but more intermediate suppliers of labor, of materials are being paid. So, you know, stage 1 matters to local governments and local employees, and that is definitely also there in OECD countries. Moreover, we see that this group of mostly rich countries has a lot more control over managing investments, right? Because so many investments are ultimately and intermediately held in OECD countries. That also means that these possible coalitions of investors and governments have a lot more influence over, you know, what happens in the oil and gas sector in terms of future investments. And especially those investments that are ultimately found not to be needed in a scenario with more ambitious climate policy. And of course, one of the policy stances, not necessarily by policymakers, but by a lot of people, is to say, look, we should divest. And I saw you have I think, don't you have a debate about this next week?
Yes.
You know, yeah, right. So obviously, divestment is a very powerful tool, especially if everybody divests, because then capital really dries up for these companies. But one thing that I want to highlight here is that, you know, if one party divests, the stock is typically bought by someone else. And as long as there are enough buyers, this might just lead to ownership and leakage to less responsive parties, as we have seen last year, is private equity buying up some oil and gas fields that were, you know, actually sold by the oil companies themselves, or the rights to exploit those oil fields. So one alternative that we can see through this analysis is that if investors maybe working together with policymakers that set the appropriate incentives, work together to manage the investments in line with the transitions, then that could also be very influential over those assets that are at risk of stranding. Now, this is very high level abstract from the ivory tower here. Ivory tower. But it is something to be considered coming out of this analysis. Now, another thing I want to highlight in my last couple of minutes here is that we have so far looked at total losses. However, when we divide these losses by some indicator of the size of the country or the country's economy, such as GDP, we see that in rich countries, these losses are actually very small. And I'll show that to you here. This is the same picture that I showed you before, same order of countries, right? The biggest losers at the top, and then the next 29, the United States at the top, then Russia, China, and so on, going down, but divided by each country's GDP. And you can see that the distribution is very different now. And notably, what I want to point out here is that stage 4, that the black color means something is on a government's balance sheet. It's a state-owned company there, or a government investment in a company. And you see a lot of black. So the biggest risks relative to a country's size are actually on government's balance sheets, raising questions about sovereign solvency and debt crises in countries that do rely so much on the profits ultimately from these investments. So on the flip side, it's actually not very costly for a number of rich countries to deal with these stranded assets. And, perhaps if there's such a management of investments, to think about ways not to let it come to social hardship for, say, pensioners whose pension funds are affected by this. And we're currently working on more on this, where, who's ultimately actually owning, what socioeconomic groups are owning these potentially stranded assets. Okay, I said that, and then so we have basically the worst risks. Despite the distribution of the magnitude and the ability of richer countries to influence future investments, we still have the worst risks in less diversified, typically not so high income countries, although some are. And what we also want to stress as a conclusion for further research to look into more is that because a lot of the loss is ultimately owned by fairly affluent persons, which I can illustrate here for the United States, we can simply map these losses into the size distribution of wealth in the United States, and the top 10% basically lose most of the wealth, or are most at risk of asset stranding. Now, of course, they're also very rich, so their loss relative to assets is not much higher than for the lower, less wealthy groups in the United States. But in absolute terms, most of the money at risk is owned by very affluent persons who are often politically influential and therefore might have an interest in, not letting assets strand. Okay, well, I have to skip over this whole question of sell-off due to time. Feel free to ask me, but this is basically from the supply side. So I conclude, rich country stakeholders have a bigger stake in oil and gas transition than the stranded assets. Literature so far suggests that's both a risk, influential groups could push for bailouts and therefore realize these investments, and putting a question mark behind climate change mitigation plans. It's also an opportunity. There's more leverage about global investments vested with a fairly small group of investors and governments that, at least are trying to be at the forefront of climate change mitigation. And then we have this financial geography that highlights the importance of international cooperation, because then if they manage investments, it happens partly in other countries. So there's a need for international cooperation in managing and financing the fossil fuel phase out to lessen destabilization and social repercussions for some of those who are invested in these assets, not necessarily with much of a choice if you're a pensioner in a pension plan, for instance. Okay, well, I always am happy if you retweet my tweet that I made, and that's pinned to my profile for altmetric scores, and that's the paper. There's also an associated policy brief, which at this link you can access it open access if you want to have a summary of the paper. So thanks very much.
Okay, thank you very much, Gregor. We do have some questions, some of these fairly informed questions, so I'll do my best to express them properly. Let me try to clarify one thing on my own here. I guess you mentioned the difference between, I think your 1.4 trillion number as a loss of profits, I think you said, as opposed to a loss of revenues. And what was the total revenue loss associated with these profits? And and why is profit? How do I think about revenues versus profits as well?
So the revenues also include basically all the costs of production and also taxes and royalties, and that's about, let's see, I want to say 6.2, but I have this in a second here. About 6.2 trillion. So it's, profits are a fraction of that.
Right. Okay. And there's just one.
That's also, by the way, that's if some of you know the 2018 study by my co-authors, they look at revenue. So their 6 and 10 trillion numbers are revenue, not profits. So our numbers are consistent with each other. We're just looking here at the subset of those that affect investors as opposed to everybody who's somehow plugged into the oil and gas supply chain.
Right. Okay, we had a couple of questions, I guess, that are just kind of, questions about boundaries of your problem and what you studied, and thinking about all of the kinds of assets or things people can own in the oil and gas industry. And you mentioned upstream a lot, so I'm just going to rephrase some of these questions. One question is related to how you think about the reserves or the resources in the ground and the valuation of those versus perhaps infrastructure. I mean, in one of your slides, you referred to rigs as the starting point as opposed to some valuation of the underground resources. And then slightly or similar question, but there's a question about maybe you would call it midstream though, and maybe it's just not part of it, but pipelines, ships, other kind of transportation infrastructure. So what you did or didn't include, or how you thought about those kinds of ideas.
Yeah, those are really excellent questions. So on the first one, I'm giving you the economist's answer. I don't really care whether it's reserves or built capital or produced capital, basically because we calculate a revenue and a profit based on the joint of the two. So you're making a certain profit from extracting oil, from extracting a part of the reserves. So whatever oil you were thinking to bring in the market, and that you cannot because of reduced demand, that has a certain value, and that value, part of that value, accrues to you as a profit. So that's what's being lost. So it's not, it's clearly not all the reserves that are underground, and it may not even be all of the capital that's invested, because perhaps in the first 3 years your offshore oil platform or Arctic oil platform is still operating, and then it has to shut down. So oil and revenue, profit and revenue is per barrel of oil, is per cubic meter of gas. So it's an economic approach to this, as opposed to looking more at the very, very important and valid more physical question of maybe what share of the reserves is still recoverable or not, or what happens to the physical infrastructure on top of it and equipment.
Okay, so if I were to summarize it, some combination of man-made assets and natural assets, oil gas in the ground, if you will, and you're trying to project, how much is actually going to get extracted, and then valuing that. And over a 15-year time frame, I think you said.
Exactly. So yeah, so it's very scenario specific. And I mentioned a couple of other scenarios without going too much into them. They're all very discussed in quite some detail in the supplementary information, if you want to give it that much time, of the paper. But this can vary from under 1 trillion, a little bit under 1 trillion, if we adjust our initial expectation to one that is already kind of assuming that due to the current trends in technology and cost advantages of renewables, demand is not going to go much further anyway. And one that is more than 2 trillion in losses, in profits, because we're assuming, we're looking at the extreme of this 1.5 degree trajectory that's consistent with that. And that, of course, leads to a lot more demand destruction in the next years. Now, there was one other question, which was about midstream. Yeah, we don't have that, or downstream, or refineries, all of that. Yes, so in that sense, the losses are a subset of the potential total losses. I think it's an important subset because I think because of the rents from different productivities of different stretches of land and its oil and gas reserves, you can make really large profits on oil and gas production. I mean, we see that right now with the merit order in power markets, right? The most expensive asset sets the price for everything. Some are making a lot of profit. Well, with oil and gas, it's of course kind of similar. The most you can correct me on the details, but conceptually, the most expensive assets, set the price, and the other assets can make quite a substantial profit. So I think a lot of the profits in oil and gas are actually in upstream extraction, and those are, of course, also those assets that can it's very hard to use them for anything else. Whereas, of course, some of the midstream people are claiming that they can switch to hydrogen, which may or may not be feasible depending on the economics and alternatives. But so yeah, I think there's a reason to look at upstream oil and gas. And in terms of why we did that, I mean, this is my conceptual answer, but there's also a simple data availability answer. I mean, we were able to get that data at the global level, but it's hard to just expand that to just any sort of part of the supply chain.
All right. Well, before I forget, I think I'll maybe just commend you on your charts, given the different stages of data analysis in countries, and it's a hard thing to try to express all of those data. So I think you did a nice job. Here's a question. Maybe, I don't know, we'll see if you have insight. Hard to answer. It's about your, just kind of the projected scenarios. Oil, you talked mostly about oil. The question is saying, and it's kind of the question is, what about the gas scenario? I guess they're coupled or defined, and maybe the IEA or other scenarios you're using. But aside from that, is there anything else insightful or assumptions that are limiting about the combination of how many fields you look like, or oil versus gas, or some sort of mix of oil and gas that, I don't know, makes it hard to interpret your analysis, or is a complication?
Okay. I mean, first off, this is equally about oil and gas. I may just sometimes say oil, but the whole analysis is about oil and gas. And I mean, partly it's hard to disentangle because often you produce oil and gas at very similar sites, and then maybe in our data, there's often one asset that produces both, right? So it would be hard to disentangle that. Could be done by kind of splitting it, but I'm not sure. There might be some upfront costs that are distributed then over both. So it's better to do it jointly. Now, with gas, of course, the current geopolitical imperatives and the invasion of Russia, of Ukraine, to name it bluntly, I mean, really changed the map of oil, and at one level made this assumption that there's a global market for oil. Everybody buys everybody's oil subject to pipeline capacity and so on, has really changed that relative to our analysis. Although I want to point out that even prior to that, Russia has the highest physical stranded assets of all our countries, basically because a lot of their future production is supposed to come from pretty costly oil and gas fields. So, they were not looking very strong there anyway. And perhaps that has increased because Europe might make good even after 15 years not to buy Russian gas anymore. Obviously, nobody can say that now. So there's been changes there. At the same time, maybe gas markets have become even more global because more LNG terminals are being built. So it's actually easier to ship gas around. But I think I'll leave the answer here. Maybe if you want to follow up, maybe I missed something there.
Right. Yeah, if anybody wants to follow up on these questions, I'll be happy to connect you with Gregor on email. So here's I don't know how it's a related question from somebody else here, and throw in my own little tidbit at the end. But the question here is, I guess you're looking mostly out 15 years, but even looking out 15 years, particular to the US, you might need to think about investments just to keep production up due to decline rates of oil fields. So the question's kind of how did you think about decline rates of oil and gas fields in general? How does that accounted for in the modeling? And then my added question on your comment just a second ago was, what countries or data sets about oil and gas fields are not in your data set? Like, I'm not sure I saw Saudi Arabia, for example. Maybe I missed it, but those are important large data sets missing.
Right. Okay. So let me go in reverse. I mean, Saudi Arabia is in our data.
Okay.
Basically, according to, if Rystad is missing a country, but they have a pretty comprehensive coverage. So we're using their reserves also and production costs also for Saudi Arabia. Saudi Arabia maybe is not so prominent because they have pretty low cost oil. So they are very little affected through production of their oil company, Saudi Aramco, in terms of volume. So Saudi Arabia and other OPEC members actually expand production relative to a baseline scenario where everybody's sort of adhering to a certain production reserve ratio per asset, and maybe that already answers part of the other question. So as the reserves decline, production declines per time. So that's how we handle that, but I'll say a bit more about that in a moment. So they're basically ramping up production as much as they can, given reserves and fields that are developed. They are, however, losing revenues and profits, in particular profits, because they have to deal with the lower oil and gas prices in the world. And also remember that we're not modeling 1 year or 2 year fluctuations here. It's a long-term model and it's a 15-year horizon. So we clearly do not really have the current oil price spike in there, though I want to say, and gas price, excuse me, I'm talking about oil here again, but I mean both. But I do want to say that the current situation in oil and gas markets could also lead to current expectations being even more sanguine, right? Now financial investors are talking about they cannot, really do all their ESG commitments anymore. They have to earn money for their investors. So they have to go into oil and gas, which in some sense props up the expectations about the prices of these investments. So it's not clear that what we're seeing right now is sort of an invalidation of the longer term picture, if there is ambitious climate policy, or whether it actually underwrites it. Now, I wanted to say still that, how do we deal with continuing investments? That's a great point, and that could definitely be, could be looked into in more detail. I think I'm hearing in the question that, some US producers invest all the time. So what's the point of looking 10 years out there, because they're not making their investment now for 10 years in the future? I think that's a valid critique. Where one could probably distinguish more than we did the different types of extraction time patterns. That's of course very different from an offshore oil platform that you build today that's gonna produce with pretty low operating costs for the next 30 years, like the one that's currently being decided to be built in Canada, in deep offshore. I forget the name. They do not, I think. Anyway, so that different investment profiles, but we're taking more of an investor perspective here, where we're saying, well, look, if you are making a decision to invest in this oil company, you are looking, and if you're a long-term investor like a pension fund is not supposed to invest in a company in order to divest again after, to speculate in the next few months. So if you're a long-term investor, you have to form an opinion, expectations about the profitability of this company over the next several years. And the valuation of that company therefore reflects a multi-year horizon of investors. And so in that sense, to some extent, even for those who have higher operating or ongoing investment costs as opposed to higher upfront costs, investors have to form their opinions today. And we're making a compromise between a very long horizon and a much shorter horizon by picking the 15 years figure. Obviously, one could change that and the results would vary. Unsurprisingly, if you make the horizon shorter, you have fewer assets that are at risk of stranding.
Right. But as a good summary, you have some rule or equation assumption for investment, and you sort of apply it the same to all places. Is that roughly what you did, just to get the analysis done to some degree? Oh, is that right?
Sorry, I may have missed that last bit.
Oh, I was just wondering if a summary of what you said is that there's the way the economic model works is you assume there's some rule for investment related to reserves production ratio or something like you said, and you just apply this the same to every country or every field, even though it's not that way.
Yeah, so we're using a fixed extraction to reserves ratio, yes, that we apply. But we make exceptions to that when we assume a sell-off scenario where we then increase the rate of extraction for a set of low-cost countries, which of course affects the extraction rates for the rest of the world, because the low-cost countries can flood the market with that lower cost supply and thereby push out of the market others. So yeah, right.
Right. Okay. Here's a question. One of your earlier slides, represented two scenarios. The future one from, I don't know if it was OPEC or Saudi Aramco, I don't recall, but the question here is just related to perhaps what you think is in their report, if you're familiar with it, or what you might think anyway in terms of demand production from oil, coming from transition to electric vehicles, maybe sort of independent of climate concerns, just technological change, you might say, versus, climate concerns and consuming less oil. Yeah. You have any insight from the things you read, or this is kind of a side question, I think, from.
Right. I mean, there's a certain chicken and egg question here. Where does technological change come from? Where does the low cost of low carbon alternatives come from? In my opinion, this is all the result of long-term policy choices, right, that have been operating on these technologies for a long time. It's not like technological change is just sort of happening on its own. But of course, once you set it in motion, there can be very, very strong lock-in effects, and you have these wonderful power laws between cumulative investments and cumulative decline in prices that we see for a number of low carbon alternatives, such as solar PV or batteries, and by extension electric vehicles. So and I want to note here that we have we have these initial expectations and the revised expectations, and we have one set of initial expectations that kind of follows the IEA scenario, which of course the IEA is also known for being not very bullish on technological change and substitutes for fossil fuels. So, there's a pretty high fossil fuel world. And the other scenario is our preferred baseline in some sense, where the technological change trends are taken seriously and modeled out into the future by adhering to these really rather exponential rather than sort of linear growth rates in competitors. And that lowers the fossil fuel stranded assets if you already if you already take these trends into account as an investor today, right? And obviously not all investors have the same expectations. So, we're making assumptions to represent the oil and gas market. We're also making assumptions to represent sort of your average investor expectation here, which may or may not be accurate of any particular investor.
Right.
Right.
Well, and one last question here, which you may or may not have insight into, so it's okay. And this is just a question, I guess, in some sense, about other costs that might be included into oil and gas operations. And in particular, they're pointing out plugging abandoned oil wells, which argument would be here in the question. This doesn't necessarily happen to a great degree in all locations. I don't know if you have any insight into that cost versus what you've looked at or anything. Yeah.
That's a great point, and I can only refer the asker to the Carbon Tracker think tank. They have, I think, recently, maybe a year ago, published a pretty good analysis of that. So we do not have that, no. And in that sense, again, our estimates are pretty conservative because you could say we're assuming the plugging costs are, externalized by the industry and taken care of by the rest of society, or spread out. But sure, if you add those, it gets even more costly to the extent that plugging costs are brought forward. Because if you stop operating in 5 years instead of 30 years, you have to, that hurts your profit baseline right there, as opposed to in the future we're not considering.
Right. Clearly, profit reducing, and the question is how much. So, okay, well, thank you very much for your talk today. So thanks everyone for joining. Gregor Semenyuk from the University of Massachusetts at Amherst. Thanks for a great conversation today. Thank you very much.
Thank you so much for your questions.